Good morning, Mr. Murray Mullen. Thank you very much for doing this. I really appreciate your time.
Hey, good to be here.
For the listener, you're the CEO of Mullen Group, but what is Mullen Group?
Oh, Mullen Group. Well, I'd like to say we're a large logistics company, but I don't know if that's the right word now because really at Mullen Group, we don't really move anything. What we do is we invest in logistics companies. So we've got 42 independently managed business units that we invest in. And they're the ones that employ the people and generate the revenue, whatever. So we're really an investment company that invests in logistics companies. That's our primary focus. That's what I think we know best because that's where we started. We started off in trucking logistics, and we know what to look for in a quality company. And my job and the senior team is to invest in parts of the economy, in verticals of the economy, where we think we can generate a reasonable return for shareholders. And that's what we do.
And for context, about 8,000 employees, market cap of about $1.2 billion.
Yeah, we've got just over 8,000 now, and we've got a market cap of about 1.2 billion. We've distributed out over the last 15 years, 1.6 billion to shareholders. Mm-hmm. Through dividends, share buybacks, or through the original days of the investment trust. So, you know what? I'm a Warren Buffett disciple and believe you have to make money. And we distribute quite a bit to our shareholders rather than just always me investing the money on behalf of shareholders. I make money in the logistics business and you get your chunk of it as an investor. And then we continue to grow the business. So we started off very modest as one company, Mullen Trucking, 72 million in sales, and today we're about 2.25 billion.
Lots of trucks on the road. I think you have 20 or 30 trucking companies
Yeah, we've got 42 total, but they're not all trucking. Mm-hmm. They're in logistics. So some of our businesses, we move wastewater, we move produced water, we store things, we're in warehousing. So logistics is a massive word. Everybody says they're in logistics. What part of the logistics ecosystem are you in? And we're in multi parts of it. And some of it's trucking, but not all of it. Some of it is, as I said, is we just move things, whether it's water, liquor, oil, drilling rigs, but it doesn't matter. We move things.
So if you're in Western Canada, there's a good chance you've seen one of your trucking companies on the road in simple terms.
Yeah, you'll see one of our 42. We don't brand everything as Mullen Group. Mullen Group is the investment firm. I leave the brands, individual brands alone. I'm a huge believer that you get quality in small. We take advantage of large and critical mass buying and all those funky things through the corporate office. But I want individual business units. They're responsible for their business to protect their brand and to enhance it. And we just support them.
And one of your main jobs would be capital allocation in a nutshell.
Yeah, so we really are the corporate side. You're exactly right. We're the banker for all of our business units. Mm-hmm. Capital allocator, investment allocator. They operate the businesses and they're rewarded based upon how well they do in their business unit.
And the company's headquartered in Okotoks, Alberta nowadays, but originally I think you're from Calgary? You grew up here?
Well, yeah. My parents were just north of Calgary. It is pretty old. In the early days, we traveled all over where the business was. So I've lived all over, Grand Prairie, Barrhead, High Prairie, Calgary. But since 71, been in Calgary ever since.
Did your degree at the UC? I think you did a business degree as well.
Not business. I took economics and finance. So closely aligned with business.
And originally, Mullen Transportation was started by your dad, Roland. But was it always your plan to get into the family business?
Not a chance.
What were you thinking at the time?
Not a chance. That's why I went to university. I worked with my dad, and you had to work in the family business, and that was too tough. I went there, had to be a better way. So I went to university, and I got my degree, and then I ended up after the degree, I didn't know plans to go back into the family business, but my dad needed help. They lost a couple employees, and so I went in and to help out, and here I am 50 years later.
It worked out okay, though.
Yeah, well, what we did is I learned the business in the trucking business, in Mullen Trucking. I learned all aspects of it. You had to do everything as a small business. But then, I had grander visions to say we could be a capital allocator, and that's why we went public in 1993. I convinced my parents to go public. And then what we did is we provided liquidity to other entrepreneurs in other verticals, and that's why we've done maybe 100 acquisitions since we did it. So learn the business and the private business, what to do, what not to do. And then, since I went to university and I studied finance and economics and accounting, is I said, we can make a public company out of this. And when we went public, we had a $32 million market cap, and now we're $1.2 billion. So it's been a steady climb up to where we're at today. And like I said, now we have a large company. And most of them in Canada, although we have 2 or 3 in the United States right now.
And originally, Mullen Transportation was started by your dad, Roland Mullen. So maybe for the listener, who is Roland Mullen, and when did the company start, and what was it?
49. Started as a kid, one truck, left the farm. I drove my grandpa nuts because he needed my dad to work on the farm. My dad left the farm and wanted to do something different. He got into trucking, and he learned his skills. He went to the School of Hard Knocks. He did not go to university. He went to the School of Hard Knocks, but man, he had street smarts like crazy. He learned the valuable lessons. He learned the business of you got to provide a service, and you got to hire good people, and you got to do it right. So that's kind of really the thesis of how he built that business. And like a lot of entrepreneurs, my dad is no different, and my mom's part of that discussion. My dad started, but my mom was there too. She helped a whole bunch. Is that all entrepreneurs, to be successful, have to have those traits.
It's easy to look back nowadays at the success of the company, but your dad spotted an opportunity in trucking at the time, or was he just trying to pay the bills? How did he think about it?
I can tell you in the early days, it was just about paying the bills. It was just a job. That's all it was. Like most small businesses, it's just a job. It's not an investment. It's a means of having a job and kind of being your own boss. And that's how my dad started. So that's the genesis of where we started. And those lessons have been learned and transferred to all of us. And my job is to transfer to the next generation of leaders that come up in the Mullen organization, is that there's no easy path to success. It's a lot of hard work. You got to be committed, and you got to focus on the customer, and you got to hire good people, and you got to do it right. I mean, that's what you do, but you always got to adapt. If there's one thing I've learned, you must adapt as the world changes. You cannot stay where you were. When the game changes, you must change with the game. If you don't, you will be part of yesterday.
And so Mullen Transportation grew through the years. In the 60s, I think he had a couple rough patches, ended up in Alaska at some point. Maybe he had a slow time, but the business kept going.
Yeah, the business kept going. Once again, my parents moved to where business was. The business doesn't follow you. You follow the business. And that's what they did in the old days. That's why we spent lots of time moving all around Alberta. And particularly when you're dealing with the energy space, some days the fields were hot, and some days they weren't. You just kept moving. But the key of that is you got to adapt and to whatever the market is. And because the market, as I said, doesn't follow you.
Yeah. But things got better in the 70s. And by the time you joined in, I think it was 1977, the business was going pretty well.
Business started to do well. That's when myself and my brothers joined. We started to do okay. It was also a unique time in Canada, in Alberta, where Canada was doing well. And we were in the right spot at the right time. And when the economy grows, you need freight moved, you need stuff moved, etc. And Alberta was doing particularly well because it had natural resources. We parlayed along with that, and kind of the start of how we really built the private business. At that same time, the trucking industry became deregulated, which really then meant that if you were innovative and creative and all those kind of things that looked after the customer, you could grow the business, rather than the old days where it was highly regulated and the government told everybody what they could and couldn't do, etc. But our big breakthrough came with technology that really allowed us to differentiate ourselves and provide better service, and that was called satellite technology and integrated databases. And that was in the late 80s. We were the first company in Canada, trucking company, to bring satellite technology to our trucks, which gave us a huge competitive advantage at the time.
Mm-hmm.
And then we just, once again, parlayed that. Then, of course, everybody gets it. And so, like any technology, it's only yours for that short window until everybody says, "Oh, that's working." So then they copycat you, and away it goes. So, but that was a real breakthrough that allowed us to get to really grow. And then my dad at the same time made a decision to get more back into the oil patch, which I thought was the craziest thing I ever heard of. But he made that call. That's what an entrepreneur does. And we got in, and Alberta oil patch took off
In the 80s.
in the 80s. I don't know how in the heck he saw that.
Yeah.
Because I there's no way I saw it. I can tell you that. But he saw something. And I think more of it, to be honest with you, rather than he just had a passion for the oil and gas. He loved it, and he saw a little window and opportunity, and we were doing well, and he expanded into that and took us to another level. And as we built around that.
Yeah. So for the listener, you joined in 1977. I think the business got involved with energy services in the 80s. Like you said, that started to really grow, and the company really made a jump up, I think.
Yeah. That's when Mullen Trucking did, not
Right.
Mullen Group.
Okay.
Mullen, we're still in the individual Mullen Trucking stage. You're right. Those are the early days. Then the jump off point was really in 93 when we went public. That's Mullen Group.
Right.
We became a group of companies, not Mullen Trucking.
So what were you doing through the 70s and 80s? Just kind of helping out?
Just working in the business and learning the business and running a good business. We were running one of the larger private companies in Alberta and did exceptionally well. That's what allowed us to go to the public arena, is because we were running a progressive and a really good, profitable private company, and we took it public.
And were you thinking at the time, this is my career and I'm happy here and I'm going to stick around? Or were you, when you were younger?
Not so much when in the Mullen Trucking. I had grander visions to do more than just be in the trucking business. But when we went public, then of course that opened up all the new doors. And because really now you're doing transactions and capital allocation and the whole public arena game, which is way, way different than running a business.
Yeah.
And then, thankfully we got in at the right time and made some good moves. And then, you learn along the way. And that was the start of Mullen Group of companies.
Because you've been 20s and 30s in those years for you? And
yeah, I would have been, now at this time, I would have been in my early 30s when we went public in 1993. Yeah.
And you were named CEO in 1991, I think.
Yeah.
So things were going well at the company. But what made you realize that you wanted to be public? What led to that decision?
Well, the fundamental decision was my parents got to an age where they went, we don't want to invest anymore. So they had hit their mid-60s, 70s. And when you're a private company, the banks force you to sign personal guarantees and all this and all that. And I think my mom, more than my dad, decided, okay, I don't want to do that anymore. But to grow, you'd always need capital. And so they decided they wanted, okay, you boys can buy the business from us, myself and my brothers. And we said, well, with what? You hardly pay us anything, so we can't buy it. We got no money. We're just like everybody else. We're working. And at that point in time, I said to my dad, Dad, I look around, I see there's so many other entrepreneurs out there in the same position as you and Mom that are going to need liquidity. So why don't we look at going public and providing not just you with liquidity, but them with liquidity? And that became the thesis to why to go public. And that was why we went public in 1993, primarily because my parents wanted liquidity. It's not just whether they needed it. You had to figure out the business plan as to how to continue to grow. And it's always been about providing liquidity to entrepreneurs. And that's why we have so many companies in our group now.
So at that time, once you'd gone public, what was your thoughts that you could roll up some other trucking companies? What opportunity did you see?
Yes, that's what we saw. Other people that needed to monetize. You can't take it with you. You have to, you can't just transfer it, so you have to find a way to monetize everything you do. And everybody gets up to a certain age and you got to monetize, or somebody gets a health issue or something. So there's always companies to buy. There's always some seller. And all we had to do was pick the right dance partners, the right companies that we wanted in our group. But because we'd learned the lessons of how to run a good company, we knew what to look for. We knew what due diligence questions to ask. And for the most part, we've made a lot of really good acquisitions. I made a couple boo-boos along the way, but that's life. Sometimes you stretch a little bit and you think you're smarter than everybody, and that's when you learn the lesson. No, you're not. Just go stick to your thesis.
And so in those years, you had some capital from going public, but when you were looking around to buy a business, sometimes you can recognize a good business. The trick is getting it for the right price. You don't overpay and you don't dilute yourself. How did you do that through the years?
Well, you never want to overpay. Nobody does, but what's overpaying? So I'm a Warren Buffett disciple, and I read and I learned, and his thesis was, don't buy cheap. Don't worry about cheap. Buy value. So pay a fair value, pay a fair price for good value. And that's a Charlie Munger trait, that quit buying cheap, because cheap is cheap for a reason. And our reputation was always, we wanted to treat entrepreneurs with respect, because we were an entrepreneur. So we knew how they thought. If you embarrass yourself in front of them with a sting, we just didn't want to do that. So we always bought good companies at a fair price.
So you'd use a bit of your equity to purchase the
Sometimes we did. Yes.
Bit of debt, maybe.
Yeah. In the early days, we used equity when we didn't have enough cash and until we had earned the respect of other equity players. They would have had to take some equity. But then, as we got bigger and generated free cash and more investors went into our company, we had lots of capital to go invest in other companies.
And did you have a sort of metric that you input everything into that you needed to pay off these investments in 5 years, 10 years? How did you think about that to get your money out and your value?
Yeah. So, like any investment, you say, okay, what's your time horizon?
Yeah.
When you're making an investment, you're kind of like Nostradamus. You're trying to predict the future. So you have to use your instincts as to what you think the future will look like, because you have to value future cash flow.
Yeah, exactly.
Right? So when you invest in a company, you take a look at what the owner and what the team that they've got there and the business they're doing, how have they done? And then you have to extrapolate with your models and say, okay, well, what do I get out of it? And then you try and marry the two together, what they want with what you think you get. And that's the art of the deal.
Did you have a blueprint that you followed on each one and that you kind of stuck to through the years? And
you start with, you can't overpay, because once you overpay,
you'll never get your money back.
You'll never get your money back. You never get it. So you had to have the discipline, and that's why we had certain parameters and stayed within that,
right? So
that you didn't get emotional over a deal. That's when you probably make our biggest mistakes in life, is when we're too emotional and not thoughtful. So that's why you have a playbook, and we tried to stay within the playbook, but always treated people with respect. That was a trait that was built into us by our parents. Is, you treat people with respect and then you'll be okay. If I didn't think I could treat somebody with respect, I said, it's just not a deal for us. We just can't do it at the time. It's not you, it's me. But at the end of the day, we were able to do a lot of deals. So we knew how to do deals.
I think you've done about 100 deals since
We've done about 100 deals, and we have 42 companies to show for it. Some of them we combine together. That's how we've grown the business.
One way to do a deal is you buy the company, fix it up, and you get the extra cash flow and revenue as a result of your own ideas. Did you go into businesses with that mentality at times, or did you have things you could fix up, so to speak?
Well, if you're doing deals, if you're going to buy companies, you have to have that belief. You have to be an optimist that says things are going to be okay. Otherwise, you shouldn't be doing deals. We always thought we could do better, and that gets a little cocky, if you will, to be honest. You got to be careful with that one.
Yeah.
But what we do look at is this. First and foremost, I take a look at the company, and I take a look at what vertical of the economy are they servicing, and do I want in the vertical? If I don't want in the vertical, it doesn't matter what the company is. So I do all my homework on the macro scene. What verticals do I think are going to be around for a period of time? And then you take a look and say, okay, what companies do we want to get in? I will tell you this, what I've learned is there's a lot of companies I've looked at, they've got bad management. And a lot of owners, they run it for themselves. They have their own ideas. They can do whatever they want. It's their business. But we can fix bad management. I can't fix a bad business.
Yeah.
If it's a bad vertical, if I don't know how to fix it, I don't think I'm going to be able to hire somebody that's going to be able to fix it. So we instinctively know when we go to look, can we help that business get better? Restructure the balance sheet is a perfect example. So many of entrepreneurs have to lease everything. They get taken to the cleaners because they don't have a strong capital base. We bring that discipline to the business.
Mm-hmm.
Can we buy cheaper with our critical mass buying to get the cost down? But at the end of the day, we want to make sure that we're getting a company that has a good culture. If it's going to be a standalone, if it's not, then we say, does it fit in with one of our other business units? So it's either standalone or it's a tuck-in. And when you got 42 different business units as in teams, I got lots of different options with what we can do with business units today. In the early stages, that wasn't the case.
Mm-hmm.
But today we have lots of different options. But we always look, what do we get? What's the best under our umbrella? Can that investment pay off? And how long would it take? And can we operate it? Many times I have to pass. And that's with good quality company. I don't see how I can make it better, and you want too much, so I have to pass.
One of the Buffett's ideas is that you want a boring business where you can project out things and things aren't going to change, and maybe you're not looking for rapid technology advances because that's really hard to make good investments. Did you view the transportation, energy services, and all that, those sectors as an area where there was stability and that as a result you could make solid investments?
That's a good point, and it's a good thesis. And I'm not one to question Mr. Buffett. How can you? But
Good.
That's his style of investing. That's not the only style,
Mm-hmm.
right?
Mm-hmm.
Many people have done exceptionally well also, but his is the path of least resistance, but it doesn't fit the thesis where technology comes in. That's fast and furious, and honestly,
Could be your friend.
it could be your friend, it could be your foe. It's risky. Therefore, the risk-reward scenario is totally different than if you're taking the Buffett-Munger approach, which is, I want to look at cash flow and whatever. When you invest in early-stage companies, there's no cash flow. It's a belief. And you know what? Tremendous wealth has been made off of that. But Mr. Buffett was one that had his, thesis, but you can't marry the two together. You have to decide whether you run and shoot, high risk, high reward, or if you're just steady as you go and I get a 10 to 15%, return over 50 years and it works out very, very well.
Right.
So it depends on your time horizon. If you want quick and fast, go for it. If you have the patience and you just are steady and you can be comfortable with that investment, then you want more steady to go. And that's who we are. We're not run and shoot. We're more, I do not want to gamble with our investors' money. So I'm very careful where it goes, where I put it.
Yep.
I could double the size of the company, but do I want to double the size of the company and put it at risk?
Mm-hmm.
And then I don't want that going with me. So I'm very thoughtful and very disciplined. So that's where my thesis. I'm probably more of a Buffett and Charlie Munger investor than a Wall Street or Bay Street investment fund.
Right.
Yeah, they look at it differently than I do.
Mm-hmm. Another Buffett, I guess, example of a bad business is that when the horse is running fast that day, sell it, and you don't wait for the day when he goes back to be the lousy performer. How did you avoid buying lousy businesses that perhaps are running fast that week, the day or the week the seller wanted to sell it to you? How did you avoid that?
I'll give you my horse analogy, which is somewhat similar, but I tell most of my businesses leaders, and I tell our board, I said, you want to make sure that the business you're investing in is not the Kentucky Derby. What do I mean by that? Just remember, you can only run once in the Kentucky. Okay? It's the only time you can run that horse is once. And so a lot of businesses are one and done. They grew fast, and you have to look and say, did the market give it to them? and is the market sustainable? And that's my job, is to make sure we avoid the Kentucky Derby type of situation where the company was doing great, we bought into great, and then it's can't run again.
Right.
So that's where you got to spend time on the macro side, and you got to spend time on the verticals you want to invest in. Otherwise, you're gambling with shareholders' money. And I've always said, I don't think shareholders pay me to gamble with their money. They pay me to run a really good company, and they expect their dividends. So I have to be extra thoughtful on that. Now, if I have a great opportunity and I don't have the capital, well, I guess I'll go back to shareholders and ask them, what do you think of this? But I'll make the case to them on that.
And so you saw good businesses in trucking and energy services and basically what you're involved in.
Energy services was the Kentucky Derby.
Okay.
Okay? So think about the energy services. It went from, it's been cyclical all its life, right?
Mm-hmm.
And we've had energy services in this country since the start, 1905. The biggest boom we've ever had was in the 80s, and it started in the 80s and went in the 90s and 2000s.
Mm-hmm.
And that was primarily driven by the boom in the oil sands development. Now, is that energy services? That's mining. You're mining sand and deriving an energy source out of that. And why did we do that? Because the United States needed it.
Mm-hmm.
And they needed energy. And that's why NAFTA was signed.
Mm-hmm.
Nobody knows that. I guarantee most of our politicians don't know why NAFTA was signed today. And NAFTA was signed because the U.S. needed energy supply. Their domestic supply was declining at a rapid pace. And then they made a deal with Canada, is that, hey, why don't you develop that great resource up there called the oil sands, and we'll buy every barrel from you.
Yeah.
And surprisingly, NAFTA was signed. And NAFTA had in it a clause called proportionality. That's when they put their money up. In return for us giving the U.S. access to that resource that needed to be developed, oil sands, they made us a deal on autos and other trade.
Huh. Didn't know that.
That's exactly why NAFTA was signed. Don't let any politician trick you on that. No trade deal, no deal with anybody is ever signed that's one way. That's not a trade.
Yeah, for sure.
That's a transaction.
Mm-hmm.
If you're going to trade, you have to have something to trade. We traded our natural resource, which was at that time crude oil, which was embedded within oil sands. And in return, we were allowed to trade in their market. Mm-hmm. That was a trade-off. And that worked, and the boom happened in Alberta. Massive. These are multi-billion-dollar projects, plants to extract this carbon, this energy source that's embedded within within sand and bitumen. That's what they called it, right? Mm-hmm. The capital investment that came into Canada. So we did exceptionally well with that, and we rode that horse in that Kentucky Derby. But then it was over. And the reason it was over is because another technology came in. It was called multi-stage fracturing. And you know that. Once they got multi-stage fracturing, very quickly the U.S. adapted and they started putting all their money into the Permian Basin. And then not surprisingly, their oil production started to climb again. 1 million barrels per day every year for 10 straight years. Now, all of a sudden, the U.S. doesn't need Canadian oil quite as much. And when they don't need as much of our Canadian oil, what happens to our trade agreements? Right. That's the situation we got right now. So we saw that. We saw that Kentucky Derby was I went, because I'm a student of watching this up Hubert's Peak. I've watched oil production all my life. Because every progressive country in the world needs oil. You need energy. Yep. You cannot grow an economy without energy. You can say, I don't need crude oil. I want this energy. You still need energy. So I've been a student of oil since I was a kid, since I was in university. And I watched it and I went, hold it now. I started to really sour once I went, well, I'm going to all the conferences with all my peers. I'm going to New York and Boston and LA, and everybody wants to talk to you. What's going on? But every well they were drilling was producing. It's just math then. How many wells are you going to drill next year? You're going to have 3,000 rigs working, 2,000 rigs working, and you're going to produce another million. Well, hold it. Within a few years, it's going to have a problem. And so we started to really caution on the oil and gas business, and I diversified from investing in oil and gas services into more of just the general economy. Then I really accelerated that non-investment in the oil and gas business when it became evident that we could not get pipelines approved to East or West Coast to move product to another country. Everybody missed it. The Canadians missed it. All the politicians missed it. Everybody missed it. Is that when your number one customer says, I don't need you as much today, what do? Well, most people would go look for another customer. In Canada, we were ill-prepared to go look for another customer because the only way we can get to another customer is with pipe. You have to build the pipe first. You can go back and read my chairman's message. We need pipelines. It's that simple because that's your highway to the export market. We chose not to do it as Canadians. I saw that and I just went, I can't invest in the oil and gas business anymore. So we pivoted away from oil and gas in the early 2000s, 2012. I was screaming at my team, I got to get out of this business. And so we quit investing before, and then we pivoted into more of the general economy, into more consumer goods. And I put all of our capital not after the old racehorse, but into the new race over here. And that saved our company because there was a tremendous shift in the oil and gas business. And I still have not seen a recovery. This is 15 years later. I've still not seen any thesis yet that says I should put into the energy space. Now, we've now pivoted away from developing the oil sands to more natural gas, but it's the same thesis. You got to have pipe to get our resource to another customer. Otherwise, you're not. It just sits.
Right.
And that's where we're at. So the energy business is still, it's so small now. It used to be 75% of our business. It's maybe 20% of our business today. That's where you have to pivot. That's the adaptation, adopting to what the world will give you rather than defending the past decision. You got to look at it and say, what's going to happen in the next 10 years? Doesn't matter what happened in the last 10. That's irrelevant.
Do you think that if pipelines started to get built, you would look towards energy services again?
Of course.
It's a good business.
If you build the pipe, you got to drill to fill.
Right.
So that's when the economic activity happens.
Yeah.
But if you don't get the pipelines built, then this is where when you drill and all the ancillary service, that's when all the jobs come in. And there'll be jobs for a long period of time because you have to keep filling the pipe.
What's without giving away your secrets, which part of the business do you find is the most stable and has been the best revenue generator for you through the years?
Well, when the best one, when the capital was coming into Alberta and coming into Canada, by far, the best margins we ever made, the most money we ever made, is when the oil and gas business was going strong.
Mm-hmm.
And everybody did well in Alberta. And then the taps turned off. And it was turned off for two reasons, as I said. One is the U.S. found their own, so they didn't need us as much. And number two is Canadians, and then once Trudeau got in, he was totally against it, turned the taps totally off.
Yeah.
So that there was no reason to invest any incremental dollars in the oil and gas sector. So we pivoted away and we went into the next best thing I saw, which was the less than truckload business. That's just servicing business and communities and whatever. And we put all of our capital into doing those acquisitions. And now that's the biggest part of our business today. And it's the most stable because whether you believe in capitalism or socialism, people still need to eat. They still need pharmaceuticals. The number one vertical commodity that we haul today is liquor and beverage.
Yeah.
Every community, every day consumes beverage. And that's our number one. 15 years ago, I didn't haul one bottle of liquor. Today, we haul lots and lots of, and I'll say beverage and liquor, because a lot of the society's changing today where a lot of younger people are consuming non-alcoholic beverage today.
Yeah.
It's still a beverage.
Mhm.
Whether it's alcohol in it or not is, I don't give a care.
Mhm.
But that's our number one. So just servicing communities every day and getting the business down and running a really tight business. That's what we're really good at. And that's our number one vertical that we're in today. Much bigger than the oil and gas sector side. I wait for that day when capital comes back into the country, and then I'll put capital to work and we'll grow in that vertical then. But until then, I just tell my team, you just got to wait. Don't anticipate, just wait and watch.
What would it take for you to start to look back at the energy services sector? Some positive messaging from the federal government? I mean, that's one thing, but what are you looking for?
Well, you always start with the message from the federal government, and they kind of set the tone of what goes on. So under Trudeau, there was no tone. It was tone deaf.
Yeah.
That guy was totally against everything, except for one project, which they did, and that was Trans Mountain.
Bought the pipeline.
Yeah, so he bought up the pipeline because it was never going to be done under private capital, and sure enough became a massive capital project for Canadians. Cost you 30-some billion, maybe 40.
Way too much.
It's because the federal government's in charge of it, and you have this thing in Canada where you got to do everything right. You've got social license. Okay, if that's what we're going to do, that's what we're going to do.
That's fine.
But I'm just saying to you, private capital will not be coming in if your social license cost is too high, because there's no return for private capital. So I don't know how it's going to play out, but my instincts would say private capital doesn't trust that. There's just too much of a social license required in the Canadian system. It'll probably have to be somewhere between a private-public partnership.
For big projects.
For big projects where the private money comes in, they get their return, and all the social cost that go above has to be socialized.
Yeah.
That means we have to debt finance it as Canadians. To me, that's where we have to get get projects off the drawing board and off of this. Everybody wants to talk. Well, we got to do it. I know, but you have to have a plan of how we're going to do it. And you got to get permits, and then you got to get capital to come in, and then you need to have the wherewithal to get it done in markets. As we debate, as we think, as we contemplate, I can tell you the rest of the world is building projects at a rapid pace.
Yeah.
And Canadians, you just watch it go by your doorstep.
On the flip side, do you think about the fact that maybe now is the right time to be buying when everything's cheap and no one's interested in the sector, when everyone's looking the other way?
Yes, you could look at that, but when you put the odds on it, maybe it's because I've been doing it for so long, is that I can't put a high probability that it will be done anytime soon. So I make decision for shareholders. I'll let shareholders make that call. I'm not willing to make that call on their behalf because I don't want to be wrong. Because all I do is hurt too many shareholders.
How have tariffs affected Mullen Group?
Well, tariffs are the new talk of the town, and tariffs are what? Tariffs are a tax, and tariffs are not new, but tariffs have been renewed under Trump's administration, Mr. Trump's administration. Canadians don't like tariffs. Countries that have been selling into the U.S. market don't like tariffs. Most American businesses that have been trying to compete with foreign, cheaper product, like tariffs because they couldn't compete. So tariffs are just a form to help your businesses have a level playing field. Supposedly that's what they're about. But the other thing that tariffs do is they fill up the U.S. coffers into the federal government.
Mm-hmm.
Federal government in the United States need to pay down their deficit. So it's a form of paying down your deficit in my books. And people are upset because he's doing it. And I go, well, he's doing it.
Looking out for the U.S.
He's looking out for the U.S. They don't care about Canada. Get over that.
Mm-hmm. Well, that's the point of the U.S. president is
Canadian. Yeah, no Canadian should have ever voted for Trump. You shouldn't vote. You shouldn't have voted. So we got to vote for what do we do? Knowing that is what is happening, what's our next best move? That's what our politicians should be focused on. And playing tough guy and pouring out a bottle of Crown Royal
I can do anything.
is irrelevant.
Mhm.
Okay? Why are we not competitive? That's what we should be as. How do we become more competitive? And what businesses should we be in for the future? And we were lulled to sleep under free trade, and we were caught, and I explained why we got caught with that. And we now have to figure out what is it the U.S. needs to get free trade. All Canadians have to do is ask themselves one thing. If you want to trade with them, what is it they need from us?
For sure.
And don't say maple syrup or
Yeah.
autos or anything. We've
Right.
got to be careful. There's only a few things that we have that the U.S. needs, and then we can trade.
So for the listener, what are those things that?
Natural resources. I'm sorry. It's not intellectual capital. It's not. There's only one thing that we have a competitive advantage on in Canada over the U.S. It's not scale. It's not size. It's not smart people. There's smart people down there. There's smart people in Canada. But that's not a competitive advantage. The competitive advantage that they're going to need is our critical minerals, is our natural resources that we have. And that's the only thing that I can think of that would give us the playbook to be able to sit down and negotiate a trade deal. I'll trade you this, you give me that. And that's, I think, how Canada needs to really think about NAFTA 2.0. Maybe you call it 3.0 because we've been through the Canada-US-Mexican agreement. But you have to give something to the U.S. to get something. It had nothing to do with Trump. It was that way in every other previous president. You have to give something to get something.
Right. That's trade 101.
That's trade 101.
So,
But it'll be exactly the same. If you want to trade with China, if you want to get our canola, you got to give China something that they need. What do they need? They will need oil. They do not have oil.
natural resources.
They need natural resources. I suspect the U.S. doesn't want Canada trading with China.
So on the subject of competitiveness, what does Canada need to do to become more competitive in its energy resources? What can we do?
Energy resources would be one that would create, but contentious to a lot of Canadians. And that social license I talk about. But if you want to do better as a country, it would be wise to invest in natural resources.
Which means what?
I don't think you need to go to Harvard to understand that. Are there other things that Canada do? Yes, that money that we get and those jobs that we get can be then used to create so many other good social programs or hospitals or whatever you want. Sponsor other businesses for the future. If you don't have that capital today, then you got a deficit finance to sponsor them, and the young are going to have to pay for that. So you got to pay one way or the other, Canadians. Do you want to pay by developing our natural resources, or do you want to pay by having higher deficits that the young have to pay off in the future anyhow? It's your choice, Canadians. Make up your mind.
So what would be an example of energy resource development? Say more pipelines, for example? What would you say?
You need more pipelines if you're going to access more markets. The pipelines are full. So if we build more pipelines, that means somebody else needs it, natural gas or crude oil. And then once you do that, then you'd be either building an oil sands plant, another one, or you'd be drilling for natural gas. So our basin in Western Canada is not oil.
Right,
we have oil sands, which is awfully close to coal. That's carbon in rock is coal. In bitumen, in sand, it's carbon in sand or bitumen. But it's not a pool of oil. It's not like the Permian, right? We don't have big pools in Canada. We have huge natural gas resource, unlimited.
Yeah, for sure.
For sure. But in terms of oil, that would require development of another oil sands extraction plant.
So
to see that one happening under the current regulatory and political environment that we live in. Natural gas, I refer to it as the cleanest shirt in the dirty laundry, I think it's a viable path towards a better future and a cleaner future. It's not perfect, but it definitely is better than another country that's going to develop it and not do it responsibly and ethically and environmentally friendly because they don't follow those rules. So I think we have a distinct competitive advantage if we can get pipe to market, if we can get pipe to the coast. But you got to get the pipe to the coast. Otherwise, it stays in the ground. It's ours. It's ours and only ours. But the rest of the world wants it. They're willing to sign us a deal. And no, it's ours. Well, okay. We don't need it, but I think we need the jobs, and I think we need the economic activity, and I think we need tax dollars that come with economic development and resource development. That's my thesis.
Canada's budget is $100 billion deficits for this year, I think.
The chief economist for the National Bank came out with his thesis that says it ain't going to be 75, it's going to be 100.
So that's really bad and not sustainable. To what degree do you think natural resources could help balance our books?
Oh, I haven't done that. It wouldn't be as high.
But that's the point.
That wouldn't be as
It
high.
would help pay the bills.
It would definitely, because you're adding into the government coffers and kitty rather than taking out of the kitty.
Mm-hmm.
The government has to take out of the kitty.
Yeah.
Do you want the rest of us to do well so we can feed the kitty? Yes or no? Otherwise, you just deficit finance, which I think is just kicking the can down the road and not really addressing the fundamental issues, which is if you're running $100 billion deficit, we're living beyond our means.
So what do you think will take for that situation to correct itself? Pain from the Canadian citizens, long wait times, poor roads, bad health care? At what point does it change?
Yeah, we know what the outcome will be. We know you can't continue running that.
But what's the symptom? What do you see like day to day?
I tell you what we need. You need to have more young people stand up and take a stand that says we need to do this responsibly in Canada. And we need more discussion about it. Not more politicking. We need more discussion about it. And we need more young people to get engaged on this issue. What is the future you want to have? Do you want one with an economic future ahead of you? Or do you want some esoteric one? That's up to the young people to decide that, in my view.
But what's the symptom? Do you think what will it look like if we continue down this path?
Well, the first thing you've got right now is your GDP is not going up per capita, but your costs went up. Housing went up. Everything has gone up, the cost of living. So the less capital that we have to come into Canada, the less demand there is for a Canadian dollar, the more that we have to keep buying from overseas because we don't produce it here because we're not competitive. How much do you want to bet your Canadian dollar doesn't improve? A good chunk of our inflation is caused because our Canadian dollar is worth 40 cents less than, 40% less than a U.S. dollar. Mm-hmm. Nearly everything you import is traded on a U.S. dollar. Whether it comes from the U.S. or not is irrelevant. Everything is priced in a U.S. dollar, the reserve currency. So everything we import costs us 40% more because our dollar is not worth anything. Not that long ago, the Canadian dollar was at par with the U.S. dollar when we were a strong natural resource export country and our energy space was doing exceptionally well. Our dollar was equal with the U.S. dollar.
I remember that. Yep.
You remember that?
Mm-hmm.
Then you correlate back to why was it strong? Because we were a strong economy. And a strong economy is a strong dollar. And a strong dollar will help keep inflation under control.
Mm-hmm. So if you were to give a suggestion, or what would your thoughts be on what Canada needs to do to get things back on track?
Well, I'm a capitalist. I think you need to be more capital friendly, private capital friendly, and that means you need to embrace natural resources as a natural example of that. But it's not just natural resources. Mm-hmm. Canada's become not capital friendly, private capital friendly, and I don't know why you wouldn't want private capital to come into the country. I think it's fantastic for Canadians as a whole. Mm-hmm. The problem you have with when you help a certain sector, like the energy space, well, only certain people are going to really see the major beneficiary from that. The other benefits are anecdotal. The government has more money, the deficit. So, well, that doesn't help the average person. So we have to connect the dots for people to say, look.
In fact, it does.
We have to connect the dots for people and help them understand is that a strong economy is good for Canadians on multiple fronts. The weak and undereducated will always pay the highest price of not being a strong economy. And the one that has been hollowed out in Canada now is the middle class. I don't know if we have a middle class anymore. It's the cost of living is up and it costs so much to be a middle class today. So we've got to create an economy that creates more middle class. And the only way to do that is a growth economy. Mm-hmm. And the only way to get a growth economy is attract capital into the country.
So it's the fall of 2025. We got a little off track there, but speaking of growth and the economy, where does Mullen Group go
Very,
from,
very little right now.
from here?
You have to look at the macro scene. Remember I said, so I don't see a lot of growth. Where there is growth, it's because I identify a really good acquisition opportunity that I'll invest on behalf of our shareholders for a long period of time. All of our businesses are flat at best, which is what the economy is. But our growth comes if we do smart acquisitions. But we've been doing acquisitions since 1993. We'll continue to do acquisitions to grow the business, and it's just about cherry picking and making sure that you get in the right vertical with the right companies.
Are you looking to the States?
Yes, I have to look at the States.
Yeah.
If Canada's not going to be welcoming for capital,
Mhm.
I've got to look to where the U.S. is winning the capital game hands down against Canadians.
Mm-hmm.
It's more friendly. Whether you like it or not, that's not what I'm talking about.
Yeah.
From a capital perspective, they're winning the games. And I've got to look at it as my fiduciary responsibility to shareholders that they want their dividend. So that means I have to put capital to work where I can pay them.
Well, as we move towards the end, maybe a couple reflections on your career. What motivates you now?
I feel blessed. The best part of my career, is that I feel proud of what we've done as an employer. We really care about the safety of our people, the quality of life. I fight hard for our people, not for me. I've done well, but I have a duty to our 8,500 people to make sure we run the best business we can. We fight hard every day and win so that they can have good jobs. That's the best part of my career.
Helping people stay employed.
Yes. And that's the only way you get on my senior team. You have to have a duty to serve. And I told shareholders in New York this week, I said, that's my business model, the way we've structured it. And I said, our planet, if we build an organization that looks after our people will look after our shareholders.
Yeah, so you were in New York, maybe just another side track. You were in New York last weekend presenting to U.S. investors.
This week.
Who weren't too interested in Canadian equities.
There's a lot of skepticism. They've heard the political winds changing and they want to understand, but there's still a lot of skepticism as to whether it's an investable country yet, from what I gather.
You were just
but it's depressing to see that, but it's also, I understand, because even we are very, very reluctant to invest right now because it's difficult to get a good return.
It's the favorite time in your career that you've had thus far.
Well, I guess the best time was when I first started, because that was what's the best time? Maybe today.
Right now, doing this podcast.
In this market, you can never look backwards. You look backwards, have no regrets. The best time is now. It's exciting. I got the biggest company we've ever had. Oh, we got challenges. We got to work through them. We got to work through the competition. We got all this. But the Chinese proverb is the best time to plant a tree was 20 years ago. The next best time is today.
Best advice your dad ever gave you?
Best advice is you look after your people and keep going. Service. Those are fundamentals that I talk about that are built in. You can't be an organization unless you have respect for people. I don't need business from customers that don't let me have respect for my people. And I don't have people that don't have respect for people.
What would be your message for investors fall of 2025? Kind of talked about it a little bit, but where does the Mullen Group go from here?
Yeah, look, we got to keep plowing ahead. It's going to be tough sledding. Sometimes it's tough. Sometimes it's not a sunny day. But if you position the company properly and you've had long-term disciplines in place, you'll be okay. We don't gamble with shareholders' money.
And in the meantime, you're at a nice, I think, 6% yield on the shares as of today.
So. You'll get that. That when the economy improves, you might get more. That's exactly right. Until then, we run the business professionally and ethically and on behalf of shareholders and our employees. I balance. That's my job. I got shareholders and I got employees. I got lots of shareholders. I got lots of employees. Mm-hmm. I got to do the right thing for both. And I try and balance the teeter-totter that's fair for everybody.
I really appreciate your time today.
Good to be here.
If that's all you want to cover, we can end the formal conversation there. Thank you.
Thank you very much.